Friend, before we dive into this journey, take a moment and look around your life. Everything you touch, every decision you make, every dream you chase, in some way, money is connected to it. But here's the crazy part. Most of us spend our entire lives using money without truly understanding what it actually is. Money feels so normal today that we forget it has a story. A long, dramatic, unpredictable story filled with invention, crisis, power, psychology, technology, human emotion, and constant evolution. A story that started with simple barter, traveled through gold and paper, broke apart during wars, rebuilt itself through banks, transformed into digital numbers, and now stands on the edge of a new era with cryptocurrencies, blockchain, and CBDCs. This isn't just the history of finance. This is the story of how humans learned to trust each other, how societies grew, how wealth was built, and how the entire world learned to move forward. In these lessons, you and I are going to explore money from every angle, not with confusing jargon, not with boring theories, but with simple, relatable human insights that actually make sense. You'll see how money shaped countries, how it shaped people, and how it shapes you, your decisions, your habits, your fears, your dreams. You'll discover how money is created, how it moves, how it grows, and why it sometimes destroys the people who misunderstand it. By the end of this audiobook, friend, you won't just know what money is. You'll understand it deeply, clearly, emotionally, in a way that changes how you think, how you earn, how you spend, how you invest, and how you build your future. So sit back, relax, and let's walk through the complete story of money, the story that shaped the world, and the story that will shape your life. Let's begin. Why money exists. When we talk about money, it's easy to picture coins, notes, or the numbers glowing on a screen. But before any of those existed, humanity faced a very simple problem. How do we exchange value in a way that doesn't create confusion or conflict? As small groups of families grew into larger communities, cooperation became more important, and the old ways of trading were no longer enough. Money didn't suddenly appear. It slowly evolved because people needed something clearer, fairer, and more reliable than the systems they had. In the earliest human settlements, barter was all people knew. They traded grain for tools, cloth for livestock, meat for pottery. Whatever they produced, they exchanged. It worked when life was simple, but the moment societies expanded, the cracks began to show. Imagine wanting wheat, while the person in front of you wants nothing to do with the fish you're offering. Unless two people wanted exactly what the other had at the same time, the trade failed. It made every exchange uncertain and unpredictable. Even when both sides agreed to trade, many goods simply couldn't be divided. Someone who owned a cow couldn't just slice off a small piece to buy oil or grain without destroying its value. And even if things matched perfectly, the physical effort was exhausting. Many goods were heavy, bulky, or difficult to transport. On top of all this, almost nothing lasted. Food spoiled, metal rusted, crops dried out. If a good couldn't survive over time, it couldn't store value. People needed a better way, one that didn't depend on luck, timing, or the durability of what they produced. As communities became larger and more connected, people discovered that trade became easier when everyone agreed to use one common item of value. This item needed to be easy to carry, easy to divide, reliable, and something people trusted. That simple understanding became the foundation of money. Instead of searching endlessly for someone who wanted what you had, you could exchange your goods for this common medium and use it whenever you needed something else. It made trade smoother, faster, and far more fair. Money also gave people a universal way to measure value. Instead of comparing one item to another endlessly, everything could be measured on the same scale. Most importantly, money allowed people to store value. It gave them a way to save buying power for the future without fear of spoilage or loss. This created stability, and stability allowed societies to grow. But from the very beginning, money relied on trust. People accepted an item as money because they believed others would accept it too. It didn't matter whether the item was shells, beads, grain, or metal. What mattered was the confidence attached to it. Without trust, money simply collapses, and that truth is still alive today in every coin, paper note, and digital balance we use. Understanding why money exists helps us understand everything that followed: metal coins, paper currency, banking, credit, and the digital systems we rely on now. Every step in the history of money was a response to human needs. The need to trade more easily, measure value more clearly, save wealth more safely, and build societies that could stand the test of time. Money didn't just make trade convenient. It made organized life possible. It allowed people to specialize, it encouraged cooperation, and it laid the foundation for economies to grow. Once money entered human life, it continued to evolve as civilization advanced, shaping the way we live, work, and connect with each other. Barter system and early trade. Before money ever came into the picture, people depended entirely on the barter system. It was a straightforward way of living, built on exchanging one physical thing for another. And for a long time, it worked well enough to keep communities alive. But as societies grew larger and people developed more skills, this simple method began to struggle. Friend, to really understand why money became necessary, we first need to understand how barter worked and why it eventually fell apart. In those early days, families and small groups produced almost everything they needed on their own. Hunters brought back meat, farmers grew crops, potters shaped vessels, and toolmakers crafted knives and axes. When someone had more of something than they needed, they traded that extra supply with someone who had a different kind of surplus. That simple give and take was the heart of barter. Everything depended on mutual need. If you had more fish than your family could eat, and someone else had more grain, you both gained from swapping. There were no coins, no fixed measurements, no formal rules, just people negotiating directly, trusting each other, and relying on the relationships within their community. Barter worked well in small groups where everyone knew everyone else and needs were limited. But soon, societies expanded. New skills appeared. Trade routes began to stretch across rivers, deserts, and early roads. As the world grew, the weaknesses of barter stood out more clearly. The biggest obstacle was something called the double coincidence of wants. It meant that a trade could only happen when both people wanted exactly what the other was offering at the same time. Imagine you're a farmer with extra grain, hoping to get livestock. But the person with livestock might not want grain at all. They might want tools instead. If you don't have tools, the trade ends right there. This simple mismatch made trade slow and unpredictable, holding back economic growth. Another problem was the lack of a standard value. Every exchange had to be negotiated from scratch. How many pots equal one goat? How much fish equals a basket of wheat? There was no consistent way to measure worth, so everything depended on bargaining skills. This often caused disagreements, confusion, and frustration, especially during bigger or more important exchanges. Then came the issue of divisibility. Some goods simply couldn't be broken into smaller pieces without destroying their usefulness. You couldn't slice a cow into parts just to buy small amounts of oil or cloth. And you couldn't divide an axe or a clay pot without ruining it. This forced people to make trades that felt unfair or impractical. Portability added even more difficulty. Many of the items people traded were heavy, large, or awkward to carry. Moving livestock, sacks of grain, or bundles of tools over long distances wasn't easy. As trade networks stretched wider, this became a serious challenge. Barter was simply not built for long-distance exchange. And of course, perishability made things worse. Food spoiled. Meat rotted. Grains were eaten by insects. Even tools rusted or wore down. People had no reliable way to store value for the future. Whatever wealth they had could easily disappear with time. Still, despite these challenges, barter played a huge role in shaping some of the earliest civilizations. Evidence shows that the Mesopotamians, Egyptians, Indus Valley cultures, and Chinese communities all used barter extensively. Long-distance trade routes carried timber, spices, metals, stones, and other goods across regions. Barter was the first major step toward organized economic life. But even the most advanced societies soon realized that barter couldn't keep up with progress. It was too slow, too uncertain, and too limited to support growing populations, expanding trade, or more complex economies. People needed something universally accepted, something that represented value clearly, something they could store, divide, measure, and easily carry. Barter was the beginning, the foundation, but its weaknesses pushed humanity towards something more powerful. And from that need, the earliest forms of money began to take shape. The first forms of money, commodity money. Friend, once people realized that barter was holding them back, they began looking for something better, something everyone could trust, carry, store, and use without endless negotiation. This search didn't happen overnight, and no one sat down to officially design a currency. Instead, through countless exchanges and shared habits, communities slowly discovered objects that worked well for trade. These everyday items, valuable on their own and useful even outside trading, became the earliest forms of money. We call them commodity money. People naturally chose objects that mattered in their daily lives or held special meaning in their cultures. Over time, some items simply became easier to exchange than others. They were accepted more often, trusted more deeply, and used so frequently that they quietly transformed into a common medium of exchange. Commodity money filled the gaps that barter couldn't handle. It offered a way to trade smoothly, measure value more clearly, and store wealth with greater reliability. One of the most fascinating examples is the cowrie shell. These small, shiny shells traveled across Africa, Asia, and the islands of the Pacific for centuries. They were light, durable, and naturally beautiful. In places like ancient China, India, Africa, and Southeast Asia, cowries became so popular that they effectively worked as a global currency long before the modern world existed. People trusted them because they were hard to counterfeit, easy to carry, and valuable enough to be exchanged widely. For many societies, cowries were the first taste of a truly portable and reliable form of money. In agricultural civilizations, basic necessities often became currency. Grains, wheat, rice, and barley acted as a medium of exchange because they were essential for survival and stored in large community granaries. In Mesopotamia, workers were paid in barley. In the Roman world, salt was so precious that a person's salary was tied to it. These consumable goods held real value, but they had their limits. Grain could spoil, insects could destroy storage, and even salt was vulnerable to moisture. These challenges kept them from becoming perfect long-term money. Livestock, too, played a big role in early wealth. Cattle, goats, and sheep symbolized prosperity, strength, and stability. Many cultures used animals for payment or to measure a family's wealth. Even our modern word fee traces back to the old word for cattle. But as you can imagine, friend, an animal is not the easiest thing to use for everyday purchases. You couldn't divide it for small payments without ruining it, and you certainly couldn't take it everywhere. Livestock was valuable, but not convenient. As societies progressed, metal objects started taking center stage. Long before official coins existed, people used bronze rings, copper knives, and metal ingots as currency. Metals had advantages no other commodity could match. They lasted longer, could be shaped, weighed, or divided without losing value, and were useful as tools and ornaments. These qualities quietly paved the way for one of humanity's greatest financial inventions, standardized metal coins. Around the world, cultures shaped their own versions of commodity money based on what they had and what they valued. Native American tribes used beads that held cultural significance. In Micronesia, giant stone discs called rice stones represented wealth, even though they were far too heavy to move. Colonial America used tobacco as currency, while ancient China and Mongolia traded using bricks of compressed tea. All of these examples show how deeply currencies grow out of a community's environment, traditions, and needs. But eventually, even commodity money reached its limits. Some items were still bulky, others spoiled, and many lacked consistency. What one region accepted might mean nothing to another. Long-distance trade demanded something more uniform, something with clear standards and shared value. These challenges opened the door to metal coins, which would bring durability, trust, and consistency on a scale the world had never seen. Commodity money may feel simple compared to what we use today, but friend, it marked a turning point in human history. It created the first shared understanding of value and set the foundation for every monetary system that followed. Without cowries, grains, metals, or those early cultural currencies, we wouldn't have the coins, notes, and digital money we rely on now. These humble beginnings carried humanity toward a future where value could be exchanged with confidence, clarity, and a shared sense of trust. Metal money and the birth of coins. Friend, by the time people had tested every form of commodity money they could use, one truth became clear. They needed something stronger, something cleaner, something that didn't spoil, break, or fade. That's when metals began to take center stage. This shift, from everyday objects to metal, was one of the biggest turning points in the history of money. Metals offered what earlier goods couldn't: durability, portability, and a kind of stability people could depend on. They were rare enough to hold value, yet common enough for people to obtain, and they carried a natural appeal long before they were ever used for trade. Copper, silver, and gold stood out because they lasted. They didn't rot like food or wear away like tools. They could be melted, weighed, shaped, or cut without losing their worth. Compared to livestock or sacks of grain, they were light and easy to carry. Their uniformity made it simpler for people to judge value. And above all, metals already mattered to societies. They were used in tools, religious ceremonies, ornaments, and many cultural traditions. It was only natural that communities began using them as a dependable form of exchange. But before coins existed, metal money looked very different. Ancient Chinese traders carried bronze tools shaped like spades or knives. In the Mediterranean world, people exchanged lumps of copper or silver, ingots, based purely on weight. Some cultures even used metal rings, bracelets, or bars as currency. These forms worked better than barter, but they still came with problems. Every piece had to be weighed. Purity wasn't always consistent. Counterfeiting was far too easy. And as trade networks grew wider, these limitations became harder to ignore. That's when one of humanity's most brilliant financial inventions appeared, the coin. Around the 7th century BCE, in the ancient kingdom of Lydia, located in what is now Turkey, the first standardized coins were created. These early coins were made of electrum, a natural mix of gold and silver, and stamped with a symbol from the ruling authority. That stamp changed everything. It guaranteed weight. It guaranteed purity. It acted as a promise, backed by a power people trusted. Suddenly, trade became faster. People no longer needed to weigh metal pieces during every transaction. Standardized denominations helped everyone understand value instantly. The stamp gave each coin legitimacy, something even distant traders could rely on. Word spread quickly, and soon Greece, Persia, India, and China were developing their own versions, each with unique designs but built on the same core idea: value backed by authority. Across the ancient world, coins took on their own identities. Greek city-states issued beautifully crafted silver coins, and the famous Athenian owl became one of the most recognized currencies in Mediterranean trade. In India, early punch-marked silver coins appeared, pieces of metal stamped with several symbols, each punch marking its authenticity. China introduced round coins with square holes in the center, making them easy to string and carry. And Rome, with its vast empire, created one of the most organized coinage systems the ancient world had ever seen. The Roman denarius became a staple of daily life, circulating across continents and helping unify a massive economy. What made coins truly powerful wasn't just the metal. They carried the authority of a ruler or state. That mark told people, even across long distances, that this piece of metal had value they could trust. This connection between money and authority has never disappeared. Even today's paper notes and digital balances rely entirely on trust. Trust in the institutions that issue them and the systems that protect them. Coins represented a level of progress that earlier societies could only dream of. They created a common standard for measuring value. They made long-distance trade smoother and faster. They were hard to counterfeit, giving people confidence in every exchange. And for the first time, governments could control the supply of money, helping economies grow in a more organized way. Friend, with the birth of coins, trade shifted from a slow and uncertain process to something efficient, stable, and far more predictable. Metal money combined practicality with trust, setting the stage for everything that followed: paper currency, banking, credit, and eventually the digital systems we use today. Coins didn't just change trade. They changed the way societies functioned, bringing structure, consistency, and a shared sense of value to the world. Rise of banking and paper receipts. Friend, once coins became a part of everyday life, trade moved faster than ever before. But as people accumulated more gold and silver, a new problem appeared: how to keep all that wealth safe. Carrying large amounts of metal was heavy, inconvenient, and dangerous. Thieves targeted travelers. Homes didn't offer much security, and anyone moving long distances risked losing everything. This simple problem pushed societies toward one of the most important innovations in financial history: the earliest forms of banking. People needed a safe place to store their wealth, so they began turning to those they trusted the most. In ancient Mesopotamia, temples became natural guardians of valuables. Temples were sacred, respected, and well protected. They already acted as centers of community life, so people felt comfortable leaving their grain, metals, and goods there. Temple administrators recorded deposits on clay tablets, creating some of the earliest known financial records. Slowly, this idea spread. In China, India, Greece, and Egypt, wealthy merchants began offering similar services. They stored gold and silver for people and kept written records of ownership. Over time, these merchants built strong reputations for honesty and protection. Without realizing it, they were laying the groundwork for the first true banking systems. But the real breakthrough came when custodians started giving depositors a written receipt. This simple piece of paper stated how much gold or silver was being held. At first, these receipts were just proof of storage. But something remarkable happened. People began using the receipts themselves as a form of payment. Instead of withdrawing their metal, they simply handed the receipt to someone else. Whoever held the paper had the right to claim the gold. This was the birth of representative money, paper that represented real value stored somewhere safe. These paper receipts quickly became popular. They were light, easy to carry, and much safer than traveling with bags of metal. Transactions became faster because people didn't need to physically move their gold at every exchange. And most importantly, the receipts came from trusted custodians, so people had confidence in using them. As custodians received more deposits, they noticed something important. Most people didn't claim their full amount of gold at the same time. That meant a large portion of the metal sat unused. Seeing this pattern, custodians began lending part of the stored gold to others who needed it, charging interest on the loans. This simple practice gave birth to early banking. Deposits, receipts, loans, interest, these basic activities formed the heart of the first financial systems. Even though they were simple compared to modern banks, the essential ideas were already there. People trusted custodians with their wealth. Records tracked ownership. Borrowers received funds. Lenders earned returns. The entire system ran on trust and careful documentation. Meanwhile, the use of paper receipts grew so fast that paper itself began functioning like money. If people trusted the person or institution behind the receipt, they no longer needed to see the metal at all. And in China, this idea advanced even further. During the Tang and Song dynasties, merchants used flying money, lightweight paper notes that made long-distance trade easier and safer. These early notes eventually inspired governments to issue official paper currency, pushing the world closer to the money systems we recognize today. Friend, these developments may sound small, but they changed everything. Early banking brought a new level of safety and organization to economic life. It introduced the idea that value could be stored, moved, and exchanged without physically carrying gold. It created trust-based transactions, reliable record-keeping, and the first lending systems. And most importantly, it allowed paper to stand in for something valuable stored elsewhere. Without these early steps, temple storage, merchant custodians, paper receipts, and representative money, we would never have reached the age of formal banks, checks, banknotes, credit cards, or digital payments. The rise of banking wasn't just a convenience, it was a transformation that shaped the financial world we live in today. The invention of paper money. Friend, paper money feels so ordinary today that we rarely pause to appreciate just how revolutionary it truly was. Before it existed, people lived in a world ruled by metal, gold, silver, and copper coins. These coins worked well for small transactions, but when trade expanded, their limitations became impossible to ignore. Carrying large amounts of metal was heavy, risky, and impractical. Long journeys with bags of coins invited danger. Big payments required literal piles of metal. Something had to change, and slowly, the world began to embrace a new idea: value printed on paper. This idea did not appear out of nowhere. It grew naturally from the use of paper receipts that custodians issued when people stored their gold or silver. Those receipts became easier to trade than the metal itself. People trusted that anyone holding the paper could claim the real value whenever they wanted. This trust turned simple storage receipts into a powerful new tool, pieces of paper that represented wealth. But the true birthplace of paper money was China, centuries before any other civilization even imagined using it. During the Tang Dynasty, China faced a serious shortage of metal, especially copper, which was needed for minting coins. As trade grew and more people needed currency, the shortage made everyday transactions difficult. In response, merchants in the Sichuan region began offering paper certificates. These certificates represented deposits of metal coins, and people could use them just like money. They were lighter, safer, and far more convenient. When people experienced how effortless these notes made life, their popularity surged. By the time the Song dynasty arrived, the government realized the incredible potential behind these paper instruments. So it stepped in and took control, issuing the world's first official paper currency. These early banknotes, called jiaozi or jiaoqiao, weren't just receipts anymore. They were government-backed money. They became the first true paper currency in human history. China had all the right ingredients for this transformation. The economy was expanding rapidly. Trade networks were growing longer and more complex. Metal shortages limited coin production, and China had already mastered paper-making technology, which made producing notes efficient and practical. All these factors combined to push the society forward into a new monetary age. Even though China embraced paper money early, the rest of the world took much longer to understand its value. When travelers like Marco Polo visited China in the 13th century, they were amazed to see people using paper as if it were gold. Europeans, who were deeply attached to metal coins, found it hard to imagine paper being worth anything. But slowly, centuries later, the idea began to spread. In the 1660s, banks in Sweden issued the first European banknotes. Just like in China, these notes represented deposits stored at the bank. Soon, England followed through the Bank of England, and by the 18th century, paper money began appearing in North American colonies as well. Eventually, nations across the world adopted paper currency as their economies expanded, realizing that coins alone could not support growing trade and financial systems. Paper money brought tremendous advantages. It was light and easy to carry. Large payments became manageable with a few sheets instead of heavy sacks. Economies were no longer limited by the supply of precious metals, allowing growth even when gold or silver was scarce. Paper stored well, traveled well, and made long-distance trade far smoother. Governments also gained the ability to manage money supply more effectively, laying the foundation for central banking. Of course, this new form of money brought challenges too. Counterfeiting grew into a constant threat, forcing governments to develop seals, special inks, and complex designs to protect the currency. And because paper money could be printed quickly, careless governments sometimes produced too much, leading to inflation. But even with these risks, societies embraced paper money because it made everyday life easier, faster, and far more efficient. Friend, the invention of paper money was a turning point that transformed how humans stored value, made payments, and conducted trade. What began as simple paper receipts evolved into one of the most important financial innovations in history. From ancient China to the rest of the world, paper currency became the backbone of modern economies. It set the stage for national currencies, central banks, and eventually the digital money we use today. Without this shift, the global financial system as we know it simply wouldn't exist. The gold standard era. Friend, the gold standard was one of the most powerful and influential systems the world has ever used. For more than a century, many major countries tied their currencies directly to gold. This meant every piece of paper money represented a specific amount of real gold, stored safely in a government vault. Anyone could walk into a bank, hand over their notes, and walk out with gold. That promise created a sense of trust and stability that shaped global trade and economic life for generations. At its core, the gold standard was simple. A government declared that 1 unit of its currency equaled a fixed weight of gold. Because of that promise, people believed in the value of their money. They knew it wasn't just paper. It was backed by something tangible and precious. This system also kept governments disciplined. They couldn't print unlimited money because every banknote had to be supported by gold reserves. As a result, inflation stayed low, predictable, and steady. And with each country tying its money to gold, international trade became easier because exchange rates barely moved. Merchants, travelers, and governments could plan with confidence. Gold had always been a trusted store of value. It was rare, beautiful, durable, and resistant to corrosion. Its qualities gave people a sense of security that paper alone could not provide. Under the gold standard, gold became the anchor for entire financial systems. People believed in their money because they believed in gold. This trust spread far beyond borders. During the 19th and early 20th centuries, global trade was booming. Countries needed a stable way to convert one currency into another. The gold standard provided exactly that. Since each currency was linked to the same metal, exchange rates became stable and predictable. This stability supported long-term trade agreements, encouraged investment across nations, and pushed global commerce forward. It was a period when money felt reliable, and economies were deeply connected through this shared foundation. Over time, different forms of the gold standard appeared. In the gold coin standard, people used actual gold coins in daily transactions. Later, the gold bullion standard kept gold stored as bars, while currency represented those bars instead of circulating them. Then came the gold exchange standard, where smaller countries held foreign currencies backed by gold instead of keeping gold themselves. Despite these differences, the basic principle remained the same. Money was tied directly to gold. The strengths of the gold standard were clear. It kept inflation low because new money could only be created when new gold was mined. It built enormous trust since people knew their currency had real value behind it. Exchange rates remained steady, which made international trade smooth and predictable. And governments were forced to spend responsibly because they couldn't simply print money without the gold to support it. But friend, the system also had serious weaknesses. The biggest issue was that the supply of money depended entirely on the supply of gold. If economies grew faster than gold supplies, money became scarce and economic growth slowed. When crises struck, governments couldn't react quickly because they were trapped by the rules of the system. Even big gold discoveries caused problems by suddenly increasing money supply and affecting prices. As economies expanded and industrialized, the gold standard began to feel too rigid, too slow, and too limiting. The first major cracks appeared during World War I. Countries needed huge amounts of money to fund the war, but their gold reserves couldn't support the spending. Many nations suspended gold convertibility because it simply wasn't practical. After the war, they tried to restore the system, but the world had changed. Economies were larger, trade was more complex, and the Great Depression created pressures governments couldn't handle under gold-backed rules. They needed flexibility to stimulate their economies, but the gold standard tied their hands. By the mid-1900s, most countries had abandoned the system entirely. The final turning point came in 1971, when the United States ended the ability to convert dollars into gold. That single decision marked the official end of the gold standard era and opened the door to the modern world of fiat money, money based on trust in governments rather than precious metals. Friend, the gold standard left a powerful legacy. It shaped the global economy, built international trade networks, and created decades of stability. But as economies grew and the world became more interconnected, the system simply couldn't keep up. Its collapse allowed nations to adopt more flexible monetary policies, develop central banking systems, and eventually move toward the financial world we know today. Why the world abandoned the gold standard? Friend, the gold standard brought the world stability for many decades, but as time moved on and economies grew more complex, its limits became impossible to ignore. What once worked beautifully in a simpler world began to hold nations back when industries expanded, global trade accelerated, and crises demanded quick action. By the 20th century, countries realized they needed more freedom than gold could give them. This shift was not because gold lost value. It was because the world changed, and the gold standard simply couldn't keep up. Under this system, money supply could only grow when new gold was mined. That wasn't a problem in ancient or early industrial times, when economies were small and pace was slow. But when factories, railways, shipping industries, and new technologies exploded across the world, economies needed far more money in circulation to support growth. The challenge was simple. Economic needs expanded quickly, but gold did not. Because the supply of money was tied tightly to the supply of gold, governments struggled to create enough currency for investments, jobs, and development. This rigidity began to choke progress. Then came war. World War I changed everything. Countries needed enormous amounts of money to fund soldiers, weapons, supplies, and rebuilding efforts. Their gold reserves were nowhere near enough to support these expenses. Nations faced an impossible choice. Either stick to the gold standard and fail to finance the war, or temporarily suspend the system and print more money. Most countries had to abandon gold convertibility just to survive the conflict. That decision marked the beginning of the system's decline. After the war, many countries tried desperately to return to the gold standard, but the world had changed too much. Nations carried heavy war debts, gold reserves were unevenly distributed, and economies were fragile. Trying to force the old system back into place created deflation, unemployment, and economic hardship. It became clear that the gold standard no longer fit the conditions of the modern world. Then the Great Depression struck. It exposed the gold standard's biggest weakness. Governments had almost no power to respond to deep economic pain. They couldn't print more money. They couldn't lower interest rates freely. They couldn't stimulate spending or inject liquidity into the system. As businesses collapsed and unemployment soared, countries needed flexible tools to revive their economies. But the gold standard trapped them. One by one, nations abandoned gold convertibility to regain control and fight deflation. Another major issue was the uneven distribution of gold. By the mid-20th century, a few countries, especially the United States, held most of the world's gold. This created huge imbalances. Countries with small gold reserves had limited money supply and struggled to support imports or maintain stable exchange rates. Those with large reserves had far greater economic power. This imbalance made global trade and cooperation difficult. In 1944, the world attempted a compromise through the Bretton Woods Agreement. The US dollar was tied to gold, and other nations tied their currencies to the dollar. This system tried to capture the stability of gold while offering some flexibility. But as global trade expanded, the world needed more dollars than the US had gold to back them. Nations held massive amounts of dollars that weren't fully supported by gold reserves. Confidence weakened, and pressure on the system built quickly. Finally, in 1971, the last link between currency and gold snapped. U.S. President Richard Nixon suspended the convertibility of dollars into gold, a moment known as the Nixon shock. It was the official end of the gold standard worldwide. From that point on, major world currencies became fully fiat, based on government authority and public trust rather than precious metals. Fiat money gave countries the flexibility they desperately needed. Central banks could now adjust interest rates, expand or tighten money supply, and respond quickly to recessions. Governments gained powerful tools to manage inflation, support employment, and stabilize the economy. Modern financial systems became possible only because money was no longer chained to gold. Friend, the gold standard didn't fail because gold stopped being valuable. It failed because the world outgrew its limitations. Wars, global trade, industrial expansion, and economic crises demanded flexibility that gold-backed currencies could never offer. Fiat money, today's money system. Friends, today almost every country depends on fiat money, the notes in your wallet, the coins you use for small purchases, and the digital balances you see in your bank app. Unlike the old days when money was backed by gold or silver, today's currency gets its value from something far less physical but even more powerful: trust. Fiat money is built on the confidence people have in their governments, their institutions, and the stability of their economies. It works not because it is made of something valuable, but because we all agree to treat it as valuable. The term fiat comes from Latin and means "let it be done" or "by decree." That's exactly how this system works. A government declares its currency to be legal tender, meaning everyone must accept it for payments and debts within that country. This type of money has no intrinsic value. It isn't precious metal, and it's not backed by anything you can touch, but it functions because people believe the issuing authority will maintain its stability. Laws support it, businesses accept it, and the entire financial system rests on the trust that this money will hold value tomorrow, next week, and next year. Fiat money replaced the gold standard for one major reason. Modern economies needed more flexibility than gold could ever allow. As countries grew, they needed tools to respond to recessions, control inflation, support banks, and manage economic ups and downs. With fiat money, central banks gained the ability to adjust the money supply, raise or lower interest rates, and step in during crises to keep the system stable. Without this flexibility, governments would struggle to respond to fast-moving financial challenges. The value of fiat money comes from a few simple but powerful beliefs. People trust that the government will maintain order and stability. They trust that businesses will accept the currency in exchange for goods and services. They know that taxes must be paid in that currency, which guarantees its use. And they trust banks to store and transfer their money safely. This trust is the foundation of the entire system. When it weakens, as in cases of hyperinflation, fiat currency can lose value quickly. But in countries with strong institutions, fiat money remains stable and dependable. Central banks play a major role in keeping this trust intact. Institutions like the Federal Reserve, the European Central Bank, and the Reserve Bank of India guide the supply and movement of money. Their responsibilities include controlling inflation, setting interest rates, regulating banks, and maintaining financial stability. Through tools like policy rates, open market operations, and reserve requirements, they help manage the flow of money in the economy. Fiat money also offers advantages that older systems simply couldn't match. It allows economies to expand without waiting for new gold to be mined. Governments can respond to recessions by injecting liquidity when needed. Banks can lend more easily, supporting businesses and investment. Paper and digital money make transactions faster and cheaper. And the cost of creating currency is far lower than the cost of digging precious metals out of the ground. But this system isn't risk-free. If governments print too much money, inflation rises and purchasing power falls. In extreme cases, hyperinflation can destroy a currency. Public confidence must be protected at all times, because trust is the lifeblood of fiat money. And when governments or central banks make poor decisions, financial instability can follow. A successful fiat system requires discipline, transparency, and strong institutions. In today's world, fiat money touches every part of economic life: daily purchases, business operations, government spending, banking, digital transfers, and international trade. And most money now exists only as numbers on a screen. Digital payments, bank deposits, and online transactions are all forms of fiat currency recorded electronically. Fiat money continues to dominate because it adapts. It can expand or contract with the economy. It gives governments the tools they need to guide growth and handle crises. And technology has strengthened it even further through instant transfers, online banking, mobile wallets, and global payment networks. Friend, fiat money is the foundation of the financial world we live in today. Its value doesn't come from metal, it comes from trust, law, and careful regulation. It gives modern economies the flexibility they need to grow, trade, innovate, and respond to challenges. Understanding fiat money is essential to understanding how today's entire economic system works. Central banking. Friend, central banks sit quietly at the center of every modern financial system, shaping the money we use, the loans we take, and the stability we rely on. Even though most people don't think about them in everyday life, their decisions affect everything, from the interest on a home loan to the price of groceries. To understand today's money system, you need to understand the role central banks play, because they are the guardians of stability in our economies. Before central banks existed, financial systems were chaotic. Private banks issued their own notes, each with different values. Lending was unpredictable. Banking crises were common, and people often lost their savings when a bank failed. Governments had very little control over the money circulating in the economy, and inflation could spiral quickly. This lack of structure created uncertainty for everyone. Central banks were created to bring order. They were designed to stabilize currency, regulate banking activity, prevent financial disasters, and ensure that money flowed reliably through the economy. Over time, they grew into powerful institutions, becoming essential to national and global financial health. One of their most important responsibilities is controlling the money supply. They decide how much money should circulate, and that decision affects inflation, interest rates, and the overall pace of the economy. When growth is slow, they may increase the money supply to encourage spending and investment. When inflation rises, they tighten the supply to help cool things down. This careful balance keeps prices stable and economies steady. Central banks also influence interest rates, another powerful tool. When they lower interest rates, borrowing becomes cheaper. People feel more confident taking loans for homes, cars, or business investments. When they raise rates, borrowing becomes more expensive, slowing down spending and helping control inflation. These interest rate decisions ripple through the entire financial system. Another vital role is supervision and regulation. Central banks watch over commercial banks to ensure they follow rules designed to keep the system safe. They check loan practices, require banks to hold enough capital, monitor liquidity, and enforce consumer protections. This oversight protects depositors and prevents risky behavior that could lead to financial collapse. And when a crisis hits, when people rush to withdraw money, or when banks face unexpected pressure, central banks act as the lender of last resort. They step in with emergency loans to prevent panic and keep the system functioning. This role builds confidence, reassuring the public that their deposits are safe. Central banks also manage a country's foreign exchange reserves. These reserves include foreign currencies and gold that help stabilize exchange rates and support international trade. They ensure that money, both physical cash and digital currency, is available whenever people need it. And they assist governments by handling public debt, issuing bonds, and processing national-level payments. One of the most important features of many modern central banks is independence. This means they make monetary decisions without political interference. When governments control money supply directly, there is a risk of printing too much money for short-term political gains. Independent central banks help maintain credibility, keep inflation under control, and support long-term economic stability. Even though central banks operate at a national or global level, their choices shape everyday life. Interest rates affect how much you pay for loans. Inflation affects how far your money goes when you shop. Strong bank regulation ensures that deposits are safe and systems don't collapse. Almost every financial decision people make is touched in some way by central bank policy. Friend, central banks are the backbone of modern money systems. They control how money moves, keep the financial world steady during crises, and guide economies toward stability. Without them, today's fiat money system simply wouldn't work. Understanding how central banks operate helps you see why inflation rises, why interest rates change, and how countries maintain financial stability in an unpredictable world. How modern money is created. Friend, most people imagine money being created only when governments print notes or mint coins. But in reality, that's just a tiny slice of the money we use. The truth is, modern money comes from a far more complex and fascinating process. Most of it is created digitally through banking activity. Understanding how money is born in today's world helps you see why economies grow, why prices rise, and why banks have so much influence on everyday life. Modern money comes from two main sources. First, central banks create what we call base money, physical cash, and the digital reserves that commercial banks hold with them. This includes the notes and coins we see, along with electronic balances used by financial institutions. But this part makes up only a small fraction of the total money supply. The second, much larger source is commercial banks, which create money every time they issue a loan. This might sound surprising, but it's exactly how the system works. Central banks create base money by printing currency and adding digital reserves into the banking system. Most of the time, they do this through a process known as open market operations, buying government bonds or financial assets and paying for them with new money. That new money enters the banking system as fresh reserves. But even with these powerful tools, physical cash remains a small portion of what people use. Most modern money exists only as numbers on screens. The real expansion of money happens through commercial banks. When you walk into a bank and take out a loan, the bank doesn't reach into a vault and hand you someone else's deposit. Instead, it simply creates a new deposit in your account. That money didn't exist before you borrowed it. It comes into existence the moment the bank approves your loan. This system is called fractional reserve banking, and it allows the money supply to grow far beyond what central banks create physically. To understand fractional reserve banking, imagine you deposit $1,000 into a bank. If reserves are set at 10%, the bank needs to keep only $100 and can lend out $900. When the bank lends that $900, it becomes someone else's deposit. That person spends it, and the money lands in another bank account. From there, 90% of that deposit can be lent out again, $810, and the cycle continues. Each round creates new deposit money. Even though the original amount was just $1,000, the system can generate many times more in total deposits across the economy. This happens because every loan creates two entries at the same time, a deposit for the customer and a loan asset for the bank. Since deposits count as money, the act of lending expands the supply. As borrowers spend this newly created money, it circulates, powering businesses, housing markets, and everyday economic activity. Even though commercial banks create most of the money in circulation, central banks guide the overall process. They control interest rates, making borrowing more expensive or more affordable. High interest rates slow lending and reduce money creation. Low interest rates encourage borrowing and expand the supply. Central banks also adjust reserve requirements, manage capital rules, and buy or sell government bonds to influence how much liquidity banks have. Through these tools, they steer how quickly new money flows into the economy. Today, almost all money exists digitally. Bank deposits, online transfers, credit card payments, and mobile transactions all represent digital forms of fiat money. Even though it's not physical, it carries real purchasing power because the financial system accepts it just as readily as cash. There are many misunderstandings about money creation. People often believe banks simply lend out deposits from other customers, but in truth, they create new money through lending. Many assume central banks control all money directly, but commercial banks actually create the majority of it. Central banks simply influence the pace. And while people tend to think inflation comes from printing physical notes, excessive digital money creation through loans can also drive prices upward. Money creation shapes the entire economy. It influences inflation, interest rates, housing prices, business investment, consumer spending, and economic growth. Too much money causes inflation to rise. Too little money slows the economy and leads to unemployment. Finding balance is one of the biggest challenges for central banks. Payment systems and digital transactions. Friend, in today's world, money moves faster than ever. You can send funds across cities, pay bills, receive your salary, or buy something online within seconds. Behind all of this is a massive, invisible network of payment systems working quietly in the background. These systems make sure money flows safely, smoothly, and accurately, whether you're tapping a card, transferring online, or paying with your phone. Most of the money we use today doesn't travel as notes or coins at all. It moves digitally through systems designed to keep the modern economy running every minute of the day. At its core, a payment system is simply the set of rules, technologies, and processes that allow money to move from one person or business to another. Every payment, no matter how big or small, follows the same basic steps. First, someone gives an instruction, a command to transfer money. Then the payment system processes it, checking that everything is correct and routing the transaction where it needs to go. Finally, settlement takes place, which means the actual transfer of money between banks. This structure applies whether you hand over cash, write a check, or make a digital transfer. For centuries, cash was the main method of payment. Physical money moved from one hand to another, and once it changed hands, the transaction was complete. But as economies grew and trade extended over long distances, the limits of cash became clear. You needed to be physically present. Cash could be lost or stolen. It wasn't practical for large payments or long-distance trade. These limitations pushed societies to find safer, more efficient alternatives. Checks were one of the first major steps forward. A check allowed someone to tell their bank to transfer money on their behalf. They made payments safer and more convenient, but they still required manual processing. Clearing a check took time, often days, especially when different banks or distant regions were involved. As economies expanded, speed and reliability became more important. The arrival of computers transformed everything. Banks began recording transactions electronically, and payment processing became faster and more accurate. Systems like automated clearinghouses handled millions of payments in batches, salaries, utility payments, and other routine transfers. Real-time gross settlement systems allowed large, high-value payments to settle instantly and individually. Card networks like Visa and MasterCard brought even faster transactions, approving payments within seconds through global communication networks. These electronic systems became the foundation of modern payments. Then came online banking. As the internet spread, banks gave customers access to their accounts from home or on the go. People could transfer money, pay bills, schedule payments, and manage their finances without visiting a branch. Online banking reduced delays and made everyday financial tasks far more convenient. Mobile payments pushed the transformation even further. Smartphones and apps turned payment systems into instant tools. In India, UPI revolutionized how people send money, letting anyone transfer directly from bank to bank in real time. In other countries, networks like Zelle, faster payments, and similar systems offered the same speed. Digital wallets like Apple Pay and Google Pay made it possible to pay with a phone instead of cash or cards. These tools brought speed, simplicity, and accessibility into millions of daily transactions. Behind the scenes, card payments use complex but efficient processes. When you swipe or tap your card, the merchant system sends a request through the card network. The network checks with your bank. Your bank approves or declines the transaction. The merchant receives confirmation within seconds, even though the actual settlement between banks happens later. This combination of speed and reliability is why cards are accepted almost everywhere. Because digital payments involve sensitive information, security is crucial. Payment systems use encryption to protect data, tokenization to hide card details, multi-factor authentication to verify identity, and real-time fraud detection to catch suspicious activity. These layers of protection work together to make sure digital transactions remain safe. Digital payments now dominate because they are fast, efficient, and accessible. They allow instant transfers, reduce the need for cash, support global business, lower transaction costs, and offer detailed records for users and businesses. They operate around the clock and connect people across the world. As technology continues to advance, digital transactions have become the natural choice for modern life. Today, these systems form the backbone of our financial world. They keep money moving safely and swiftly across countries, banks, and digital platforms. Inflation, deflation, and purchasing power. Friend, whenever you go to the market and notice prices rising, or when your savings don't seem to stretch as far as before, you're experiencing the effects of inflation. On the other hand, when prices fall and businesses struggle, that's deflation at work. These two forces shape the value of money more than anything else. Understanding them helps you see how your money changes over time, why things get more expensive, and why central banks work so hard to keep prices stable. Inflation simply means that prices rise across the economy. When this happens, each unit of currency buys a little less than it used to. Economists measure inflation using indexes like the Consumer Price Index. Inflation can come from many sources. Sometimes people demand more goods than businesses can produce, pushing prices up. Sometimes the cost of producing goods rises, like when raw materials or wages increase, forcing companies to charge more. Inflation can also result from too much money being created, especially when money supply grows faster than the production of goods and services. And sometimes large supply shocks, like sudden jumps in oil prices, raise costs for almost every business. A small amount of inflation is normal in a growing economy, showing that demand and activity are healthy. But inflation matters because it reduces the purchasing power of money. When prices rise, your money buys fewer things. Savings lose value unless they earn enough interest to keep up. People living on fixed incomes feel the pressure most. At the same time, borrowers can benefit because they repay loans with money that's worth less than when they borrowed it. This is why central banks aim to keep inflation low and steady, often around 2%, to protect both consumers and the economy. Extreme inflation, known as hyperinflation, is far more dangerous. You may have heard about Germany in the 1920s or Zimbabwe in the 2000s, when prices doubled within days or weeks. In situations like these, people lose trust in the currency entirely. They may turn to foreign money, gold, or even barter, because their national money becomes nearly worthless. Hyperinflation usually happens when governments print excessive money, or when economic activity collapses, leaving too little production to support the currency. Deflation is the opposite. Instead of prices rising, they fall. At first, falling prices might sound like a good thing. But in reality, deflation can harm the economy deeply. When consumers delay purchases because they expect prices to drop further, businesses earn less. Their profits shrink, they cut jobs, and investment declines. As income falls, spending slows even more. Deflation also increases the real value of debt, making it harder for people and businesses to repay loans. This cycle of falling prices and falling economic activity can create long-lasting stagnation. Purchasing power ties everything together. It's the amount of goods and services you can buy with a unit of currency. When inflation rises, purchasing power falls. The money in your pocket doesn't go as far. Daily expenses increase. When deflation occurs, purchasing power rises. But the economy suffers because people stop spending. Understanding purchasing power helps you see the real value of your income, not just the number printed on your payslip. This brings us to the difference between nominal and real value. Nominal value is the number you see, your salary, your savings, your income. Real value shows what that number can actually buy after adjusting for inflation. If your salary rises slightly, but inflation rises more, your real income has actually fallen. You earn more on paper but less in reality. This difference matters for financial planning and understanding economic well-being. Central banks use several tools to control inflation and deflation. When inflation rises too high, they raise interest rates to slow borrowing and cool down the economy. When deflation threatens, they lower interest rates to encourage spending and investment. They also adjust the money supply and use communication to guide expectations. Their main goal is to maintain price stability so people can plan confidently for the future. A low and steady level of inflation supports economic growth. It encourages businesses to invest, people to spend, and economies to operate predictably. Too much inflation or too much deflation disrupts this balance and harms growth. Debt, credit, and interest. Friend, debt, credit, and interest are woven into almost everything you see in a modern economy. They shape how people buy homes, how businesses grow, and even how governments build roads and run public services. These three ideas sit at the center of the financial world, quietly influencing everyday decisions and the movement of money around us. Understanding them gives you a clear picture of how today's economy functions and why borrowing can either help or harm depending on how it's managed. Debt is simply money borrowed today with a promise to repay it in the future. It gives people and institutions access to resources right away instead of waiting years to save the full amount. Personal loans, home mortgages, business loans, and government bonds all fall under this idea. When used responsibly, debt becomes a tool, one that supports education, home ownership, business growth, and important public projects. Credit, on the other hand, is about trust. When a lender gives credit, they are trusting the borrower to repay the money with interest. Lenders look at a borrower's income, financial history, credit score, and overall ability to repay before approving a loan. Strong credit systems allow money to move smoothly from savers to borrowers, helping economies grow and supporting projects that might not be possible otherwise. People use debt because it lets them do things sooner rather than later. Individuals borrow to buy homes, pay for education, or handle large expenses over time. Businesses borrow to expand operations, upgrade technology, or manage short-term cash flow. Governments borrow to build infrastructure, support economic growth, or cover temporary financial gaps. Debt only becomes harmful when borrowing grows beyond someone's ability to repay, leading to financial stress and instability. Interest is the price of borrowing money. It compensates the lender for taking risk and giving up access to their funds for a period of time. There are two main types. Simple interest is calculated only on the original loan amount. Compound interest, on the other hand, grows on both the original amount and the interest already earned. Compound interest is powerful. It's the reason debt can grow quickly, but it's also the foundation for long-term wealth building when used for saving and investing. Interest rates change for many reasons. Central banks influence them to guide economic activity. Inflation, demand for loans, the amount of savings in the financial system, and overall economic stability all play a role. When interest rates are low, borrowing becomes easier and people spend more, stimulating the economy. When rates rise, borrowing slows, reducing spending and helping control inflation. There's a big difference between good debt and bad debt. Good debt supports long-term benefits, education, a home, or a business that can grow in value or generate future income. Bad debt goes toward items that lose value quickly or don't improve your financial future, especially if the borrowing comes with high interest. Recognizing this difference helps you borrow wisely and avoid unnecessary stress. Credit plays a major role in shaping economic cycles. When credit is easy to get, businesses invest, consumers spend, and jobs grow. But too much credit can inflate asset prices and create financial bubbles. When credit becomes tight, borrowing slows, businesses struggle, and the economy weakens. The health of an economy often depends on maintaining a careful balance. Governments use debt too. They borrow by issuing bonds, which are bought by individuals, banks, and other countries. Government debt funds infrastructure, social programs, and many essential services. But if it grows too large, it can weaken confidence, raise interest costs, and create economic challenges. That's why central banks monitor government debt closely. Debt always carries risks. Borrowers may face rising interest costs, difficulty repaying, or the possibility of losing collateral and secured loans. Lenders face risks too. Economic downturns, defaults, and inflation can reduce their returns. Managing these risks requires strong rules, responsible borrowing, and careful oversight from financial institutions. Governments, taxes, and money supply. Friend, governments may feel distant from daily life, but they quietly shape the entire financial environment you live in. Through taxes, spending, and public policies, they influence jobs, prices, infrastructure, and even how much money flows through the economy. Understanding how governments manage money helps you see why your community has roads and schools, why inflation rises or falls, and how countries keep their economies stable. Governments collect taxes because they need a steady source of revenue to keep society running. Without taxes, we wouldn't have public transport, hospitals, schools, police forces, or emergency services. Taxes pay for the systems that support daily life and make communities functional and safe. They also help reduce inequality by funding programs for people who need assistance. Roads get built, children get educated, and communities stay healthy because everyone contributes through taxes. There are many different types of taxes, each serving a specific purpose. Income tax applies to what individuals and businesses earn. Sales tax, or GST, is added to goods and services. Corporate tax is charged on company profits. Property tax supports local services through real estate contributions. Duties are applied to imported and exported goods, and excise taxes target specific products like fuel or tobacco. Together, these taxes create the financial foundation governments rely on. Government spending is just as important. When governments invest in infrastructure, healthcare, and education, they stimulate economic activity and create jobs. This spending becomes even more crucial during recessions. When private businesses slow down, economists call this fiscal policy, using government spending and taxes to influence the economy. During hard times, governments may spend more to support growth. When inflation rises, they may reduce spending or adjust taxes to cool things down. Fiscal policy works hand in hand with monetary policy from the central bank to keep the economy balanced. Government decisions also affect the money supply. While central banks control monetary policy directly, governments influence money flow through their spending and borrowing. When a government spends more than it collects through taxes, it runs a budget deficit. To fill this gap, it borrows money by issuing bonds. These bonds are bought by banks, investors, foreign countries, and sometimes central banks. This borrowing injects additional money into the economy, affecting financial conditions and indirectly increasing the money supply. Government debt builds up over time from repeated borrowing. Debt itself isn't bad. Most countries use it strategically to build infrastructure, fund development, and manage short-term financial needs. Debt becomes a problem only when it grows faster than the economy, when interest payments overwhelm the government budget, or when investors lose confidence. Managed responsibly, public debt helps support economic growth. Governments also play a role in managing inflation. If prices rise too quickly, they may reduce spending or raise taxes to slow demand. If the economy is weak, they may increase spending, lower taxes, or expand social support programs. These tools help keep the economy stable and protect people's purchasing power. Public policies affect individual lives in many ways. Income taxes determine how much of your paycheck you keep. GST and other sales taxes influence the cost of everyday goods. Education and healthcare depend on government funding. Housing markets shift based on tax incentives or subsidies. In many ways, government decisions shape both the financial opportunities available to you and the quality of the services you rely on. Although central banks operate independently, governments and central banks must work together. Central banks manage money supply and interest rates, while governments control spending and taxes. When both sides coordinate effectively, the economy grows steadily, prices remain stable, jobs stay available, and the financial system stays secure. Global money system and Forex. Friend, today's world is deeply connected. No country stands alone. Nations trade goods, invest across borders, borrow from each other, and depend on global markets to keep their economies running smoothly. At the center of all this movement is the global money system, an enormous, interconnected network that lets different currencies interact. And the heart of that system is the Forex market, the place where currencies are bought, sold, and valued every second of every day. Understanding how this system works helps you understand why the value of your currency rises or falls and how countries stay connected through money. As international trade expanded, countries needed a way to exchange currencies. Imagine a seller in India trying to accept payment from a buyer in Japan. Without a system for converting rupees to yen, the transaction couldn't happen. The global money system emerged to solve problems like this. It created a smoother way for currencies to be exchanged, allowed countries to settle international trade safely, supported cross-border investments, and built standards for cooperation. Without it, global trade would be slow, uncertain, and full of risk. The Forex market, short for foreign exchange, is the biggest financial market in the world. It never sleeps. It runs 24 hours a day, moving through financial centers in London, New York, Tokyo, Singapore, and Sydney. And it isn't a physical place. It's a vast digital network of banks, financial institutions, governments, corporations, and traders. Its main job is simple but powerful. It determines the exchange rates between currencies. If one US dollar is worth a certain amount of Japanese yen, that value is shaped by the constant buying and selling happening in Forex. Exchange rates change constantly because many forces influence them. Higher interest rates attract foreign investment, lifting the value of a currency. Countries with low inflation often have stronger currencies because their money holds value over time. Strong economic performance attracts confidence and investment. Political stability helps build trust. Trade balances, such as whether a country exports more than it imports, also matter. And then there's speculation. Traders make decisions based on what they think might happen next. All these factors interact every second, making the Forex market dynamic and always shifting. International trade depends heavily on Forex. If an Indian company buys electronics from Japan, it must pay in yen. If a US company sells machinery to Germany, it receives euros. Forex makes these payments possible by converting currencies quickly and reliably. Companies also use the Forex market to protect themselves from sudden changes in exchange rates and to understand the true cost of goods across borders. Without this system, trading between nations would be slow, unpredictable, and far more expensive. Some currencies, like the US dollar, play a special role in the global system. These are called reserve currencies. They are widely trusted and used in international trade, global investment, and even for pricing commodities like oil and gold. The US dollar is the most dominant reserve currency, followed by the euro, the yen, and the British pound. Countries hold these currencies in their reserves to stabilize their own money and make global transactions easier. Central banks also play an important role in the global money system. They manage their country's foreign currency reserves, intervene in Forex markets when needed, and set interest rates that influence currency values. They also work with groups like the IMF, the World Bank, and the BIS to support financial stability and help countries dealing with economic challenges. Through these organizations, nations cooperate, share information, and support each other in times of need. Countries choose different exchange rate systems based on their economic goals. Some let their currencies float freely, meaning the market decides the value. Others use fixed exchange rates, pegging their currency to another currency like the US dollar. Some use a managed float, allowing the market to operate most of the time but stepping in when things get unstable. Each approach has benefits and drawbacks, influencing trade, stability, and competitiveness. The global money system affects everyone, even if you never trade currencies yourself. It influences the price of imported goods, the cost of traveling abroad, how profitable businesses are, and how much investors earn. It shapes inflation, affects job markets, and determines how easily governments can borrow money internationally. Every time you buy something made in another country, the global money system is involved. Friend, the global money system and the Forex market are the backbone of international commerce. They make it possible for countries to trade, invest, and stay connected financially. Exchange rates reflect the health of economies and the confidence of global markets. Understanding how this system works helps you see the deep connections between nations and how money moves across the world every moment of the day. The rise of digital money. Friend, today we live in a world where money moves at the speed of a tap. You can send money, pay bills, shop online, or receive your salary, all without touching a single note or coin. Digital money has quietly become the backbone of modern life. Most of the money we use today doesn't physically exist at all. It lives as digital records stored in computer systems, moving across apps and networks with incredible speed. Understanding how this transformation happened helps you see just how far our financial world has come. The journey began when banks shifted from paper ledgers to computer databases. Instead of writing down deposits and withdrawals by hand, banks started storing all financial information electronically. This made transactions faster, more accurate, and easier to manage. Debit cards and ATMs soon followed, letting people access money digitally without visiting a bank branch. Online banking took things even further, allowing people to manage accounts from their computers. These early steps laid the foundation for a world where physical cash became less important. Then smartphones arrived, and everything accelerated. Suddenly, people could check balances, transfer money, and pay bills right from their mobile devices. Mobile banking apps made it possible to manage finances anytime, anywhere. Salary payments, savings, investments, and transfers became just a few taps away. For millions of people who never had easy access to traditional banks, mobile phones opened the door to financial services that had once been out of reach. Digital wallets became the next major breakthrough. Apps like Apple Pay, Google Pay, Paytm, and many regional wallets allowed people to store their card details securely on their phones. Payments became as simple as scanning a QR code or tapping a phone near a payment terminal. Digital wallets offered convenience, speed, and strong security through encryption and advanced authentication. They also helped users keep track of their spending in real time. More and more people began choosing digital wallets over cash or physical cards for everyday purchases. Instant payment systems transformed digital money even further. Instead of waiting hours or days for transfers, people could send money seconds after typing in an amount. Systems like UPI, Faster Payments, Zelle, Pix, and others around the world made digital transfers available 24/7, including weekends and holidays. Businesses embraced these systems for their reliability and low cost. Individuals loved them for their simplicity and speed. Instant payments have become a core part of how modern economies function. Digital money also fuels e-commerce. Without digital payments, online shopping simply wouldn't exist. Today, buying something from across the world is effortless. People use debit cards, credit cards, digital wallets, and online banking to pay for products, subscriptions, and services. Digital money made this entire global marketplace possible. As digital money grew, so did digital-only banks, sometimes called neobanks. These banks operate entirely online without physical branches. They attract people with simple apps, low fees, quick account opening, and transparent financial tools. Neobanks have made banking more accessible, especially for younger generations and people comfortable with technology. With all these changes, security has become more important than ever. Banks and financial institutions protect digital money with encryption, biometrics, two-factor authentication, fraud detection, and secure communication systems. Governments and central banks regulate digital platforms to prevent fraud, protect users, and maintain stability across financial networks. Digital money brings many benefits. Transactions become faster and cheaper. Cash handling is reduced. Financial activity becomes transparent and easier to track. People gain better access to banking services without needing to visit a branch. Businesses operate more efficiently, and governments can manage payments with far less complexity. Digital money reduces the risk of theft and simplifies daily financial life. But it also brings challenges. Cybersecurity threats are always evolving. Some people still lack internet access or digital skills, creating a gap in inclusion. Privacy concerns arise when more data moves online, and digital systems depend on technology that must stay reliable to prevent outages and disruptions. These issues require continuous innovation and thoughtful regulation. As technology keeps advancing, digital money will remain at the center of economic growth and the way we interact with money every day. Cryptocurrency and blockchain money. Friend, over the last decade, a completely new kind of money has entered the world. Money that doesn't come from a government, doesn't exist in physical form, and isn't controlled by any single authority. This is cryptocurrency. It represents one of the biggest financial shifts of the digital age, and it has changed the way people think about value, trust, and the future of money. Understanding it helps you see where global finance may be heading in the years to come. Cryptocurrency is digital money protected by cryptography. There are no notes, no coins, only digital units recorded on computer networks. Bitcoin, created in 2009, was the first cryptocurrency and remains the most well-known. What makes cryptocurrencies different is that they operate without a central bank or government. Instead, they run on decentralized networks where people can send money directly to one another, peer-to-peer, without relying on intermediaries like banks. Strong encryption protects the system, and every transaction is recorded securely. The technology behind most cryptocurrencies is called blockchain. Think of blockchain as a public ledger that everyone on the network shares. Instead of one institution controlling the record of transactions, many computers, called nodes, keep identical copies. Each block added to this ledger contains a list of transactions, a timestamp, a cryptographic code, and a link to the previous block. Blocks form a chain, and once added, they cannot be easily altered. This structure keeps the system transparent and tamper-proof. Blockchain security comes from decentralization and cryptography. No single point controls the network, so it's extremely hard to attack. Cryptographic hashing protects the data from being changed, and consensus algorithms, like proof of work or proof of stake, ensure that everyone agrees which transactions are valid before they are added to the ledger. These mechanisms make blockchain secure without needing a central authority. Cryptocurrencies emerged for many reasons. People wanted faster and cheaper international transfers. They wanted financial systems that didn't depend on banks or governments. Many regions lacked access to basic banking, and digital technology created opportunities for inclusion. And as the digital economy grew, people sought new ways to move value online. Bitcoin's mysterious creator, known as Satoshi Nakamoto, designed a system that allowed individuals to transfer value securely across the world without relying on traditional finance. Since Bitcoin's rise, many other cryptocurrencies have appeared. Ethereum introduced smart contracts, opening the door to decentralized applications and new financial services. Stablecoins like USDT and USDC are tied to real-world currencies to keep their value steady. Other networks, such as Binance Coin, Solana, and Ripple, serve specific purposes, from faster payments to financial infrastructure. Together, they form a growing digital ecosystem. Cryptocurrencies are used in many ways. People use them for digital payments that move quickly across borders. Some view Bitcoin as digital gold, a store of value that isn't controlled by any government. Smart contracts allow agreements to execute automatically without intermediaries. Decentralized finance, or DeFi, allows lending, borrowing, and trading without banks. Tokenization lets real-world assets like art or property exist in digital form. And remittances, money families send across countries, have become faster and cheaper with crypto. The advantages are clear: lower fees, faster transfers, high transparency, strong security, and less reliance on banks or middlemen. For people in regions with weak financial systems, cryptocurrencies can provide access to tools they never had before. But cryptocurrencies also face real challenges. Prices can rise or fall dramatically, making investments risky. Governments are still figuring out how to regulate them. Exchanges and wallets can be targeted by hackers. Not all businesses accept crypto yet, limiting everyday use. Some networks use large amounts of electricity. And, like any new technology, scams and frauds exist. These challenges must be addressed for cryptocurrencies to grow safely. Most experts believe cryptocurrencies won't replace traditional money completely. Instead, they will coexist, acting as digital assets, supporting decentralized finance, powering smart contract platforms, and offering new ways to transact globally. As technology improves and regulations strengthen, crypto may become more stable and more integrated into daily financial life. Central Bank Digital Currencies, CBDC. Friend, as the world moves deeper into the digital age, money is evolving once again. After coins, paper notes, and digital payments, the next major step is something called a central bank digital currency, a CBDC. Unlike cryptocurrencies created by private networks, a CBDC is a digital version of a country's official currency, issued directly by its central bank. It's modern, it's secure, and it carries the same authority as the cash in your hand. Understanding CBDCs gives you a glimpse into the future of how nations may manage and move money. A CBDC works like digital cash. You won't hold it physically. Instead, it exists electronically in a digital wallet. Because it is issued by the central bank, it is fully trustworthy and recognized as legal tender. This makes it completely different from bank deposits, mobile wallet balances, or cryptocurrencies. Those depend on private institutions or decentralized networks. A CBDC, however, is sovereign money, official, regulated, and backed by the full power of the central bank. Countries exploring CBDCs can design them in two main forms. A retail CBDC would be used by everyday people for shopping, paying bills, sending money, or receiving salaries. It would function the same way physical cash does, but in digital form. A wholesale CBDC would be used only by banks and financial institutions for large value transactions and interbank settlements. Each type supports different parts of the financial system and helps improve efficiency in different ways. So why are countries so interested in CBDCs today? Around the world, cash use is declining as people prefer digital payments. Private cryptocurrencies have grown quickly, raising concerns about financial stability. Many existing payment systems are still slow or expensive, especially for cross-border transfers. CBDCs could offer faster, cheaper, and safer alternatives while also improving financial inclusion, giving unbanked populations access to digital financial tools. And as nations modernize their financial infrastructure, CBDCs offer a new way to improve security and reduce operational costs. CBDCs work through secure digital platforms managed by the central bank. People can keep CBDC balances in a digital wallet, either directly through the central bank, through commercial banks, or through integrated payment apps. Transactions happen instantly and are recorded in protected databases. Unlike cryptocurrencies, CBDCs don't rely on decentralized validation. They operate under central bank oversight, ensuring stability and trust. The benefits of CBDCs can be powerful. Payments could become faster and far cheaper. People without bank accounts could participate more fully in the financial system. Governments could deliver subsidies, refunds, and welfare payments instantly and with less risk of fraud. Businesses could operate with greater transparency. Cash-related costs, printing, storage, transportation, would reduce sharply, and central banks would gain new tools for responding to economic changes. But CBDCs also bring challenges. Privacy is one major concern. People worry that central banks could monitor transactions too closely. Strong cybersecurity is essential to protect digital currencies from hacking. Relying heavily on technology means outages or failures could disrupt payments. If people begin holding CBDCs directly, bank deposits might decline, affecting how commercial banks operate. And ultimately, the success of CBDCs depends on public trust. Many countries are already far along in their CBDC experiments. China's digital yuan is in advanced pilot stages. The Bahamas introduced the sand dollar, one of the world's first fully deployed CBDCs. Nigeria has launched its e-naira. India is testing both retail and wholesale versions of the digital rupee. The US and European Union are conducting research and small-scale pilots. This global momentum shows that CBDCs are no longer theoretical. They are becoming a real part of the financial future. CBDCs could shape the coming decades in powerful ways. They may help create fully digital economies, reduce costs, increase transparency, and support more efficient global trade. They could make payments faster and easier for everyone, while giving central banks new tools to stabilize economies. They're not meant to replace cash entirely, but they will almost certainly sit beside it as a significant part of future money systems. Future of money. Friend, money has changed many times throughout history, and it's still changing right in front of us. We started with barter, moved to metal coins, paper notes, bank accounts, digital payments, and now cryptocurrencies and CBDCs are stepping into the picture. The future of money will be shaped by technology, global connectivity, and how people choose to interact with financial systems. When you look ahead, you can already see the early signs of a world where money moves faster, becomes smarter, and blends more deeply with our digital lives. Across many countries, the shift toward cashless living is already happening. People prefer tapping their phones, scanning QR codes, or making instant transfers instead of handling physical cash. Cashless systems offer incredible convenience and speed, reduce the cost of printing and transporting money, and improve security by lowering the risk of theft. They also make financial transactions easier to track. But even with these benefits, governments must ensure these systems remain accessible to everyone, including those who may not be fully comfortable with technology. Digital currencies are becoming a major part of the future. Cryptocurrencies and CBDCs together show a move toward money that lives almost entirely in the digital world. Cryptocurrencies may gain wider acceptance. CBDCs could become standard tools for everyday payments. Digital tokens may represent assets like real estate, stocks, or artwork, making it easier for people to invest and trade globally. These trends point toward a world where money becomes programmable, able to move across borders instantly and work within automated systems. Tokenization is another powerful idea shaping the future. It means turning ownership of assets into digital tokens on a blockchain. This makes it possible to own a small fraction of something large, like a building or a piece of valuable art. It increases liquidity and lets more people take part in markets that were once limited to wealthy or institutional investors. Through tokenization, investment becomes more open, flexible, and accessible. Artificial intelligence is also transforming finance. AI already detects fraud, analyzes creditworthiness, trades financial assets, and provides personalized financial guidance. In the future, AI may help people manage money more efficiently, offer real-time advice, and even automate parts of the financial system. It can process information faster and more accurately than humans, making financial services smarter and more responsive. Blockchain technology will continue to influence financial systems beyond just cryptocurrencies. It can power transparent supply chain payments, automate compliance through smart contracts, secure identity verification, and support decentralized finance platforms. Blockchain brings trust and transparency to systems that traditionally depend on intermediaries. As it grows, many financial activities may shift toward decentralized models. Cross-border payments are another area ready for transformation. Sending money across countries is often slow and expensive. The future aims to change that through global digital standards, interconnected CBDC systems, faster settlement methods, and decentralized networks that reduce fees. These improvements could make international trade, remittances, and global investment much more efficient. Technology is also helping millions of unbanked people gain access to financial services. Mobile banking, digital wallets, and low-cost transfer systems allow people to save, borrow, and make payments even without a traditional bank account. Digital identities help verify users securely, This kind of inclusion can lift communities out of poverty and support long-term economic growth. As money becomes more digital, privacy and regulation become critical concerns. Governments must protect citizens' data, ensure systems are secure, prevent fraud, and regulate AI responsibly. People need to trust that their financial lives are safe, even in a world where everything happens online. Strong, thoughtful regulation helps balance innovation with protection. Even with all this change, physical cash won't disappear overnight. Some people still prefer it for budgeting or privacy, and cash remains important as a backup when power or network systems fail. But over time, cash will continue to decline as digital alternatives become easier and more reliable. Money and human behavior. Friend, money may look simple on the surface, just numbers, notes, or digital balances. But deep inside, it's tied to emotions, memories, and the way we see ourselves. When we talk about money, we're really talking about human behavior. People rarely make financial decisions based only on logic. Most choices come from feelings, habits, and beliefs formed long before adulthood. When you understand the psychology behind money, you start to see why people save, spend, invest, or struggle the way they do. Money affects how safe we feel, how confident we are, how we view success, and even how we compare ourselves with others. That's why behavior often shapes financial outcomes more than any math formula. You'll notice that someone who earns less can still manage money better than someone earning far more, because behavior, not income, decides long-term stability. Emotions sit quietly behind nearly every financial decision. Fear makes people avoid investing or panic sell when markets fall. Greed pushes them toward risky decisions. Pride makes them overspend just to look successful. Guilt holds others back from buying even what they need. Stress leads to impulsive purchases or complete avoidance of financial responsibilities. These emotions are powerful, and unless you understand them, they end up controlling your choices without you realizing it. Our minds also rely on shortcuts that can mislead us. These are cognitive biases. Anchoring makes us stick to the first number we hear, even if it's irrelevant. Herd behavior makes us follow what everyone else is doing, especially in investing. Loss aversion is the reason losing money hurts far more than gaining the same amount feels good. Overconfidence makes us believe we know more than we actually do. Confirmation bias makes us look only for information that agrees with what we already believe. These biases shape how we spend, save, invest, and borrow. Even when we think we're being rational, much of our behavior around money comes from early life experiences. Childhood shapes money scripts, deep beliefs we carry into adulthood. If you grew up in a home where money was always tight, you may feel anxious and hoard every rupee. If your family believed wealth was something only others had, you may hesitate to take financial risks even when opportunities arise. Some people learn that talking about money is shameful, so they avoid it their whole lives. Others learn that money equals success, pushing them to overspend just to feel worthy. These scripts run in the background unless we bring awareness to them. Culture and society also shape how we think about money. Some cultures value saving and simplicity, while others encourage spending to improve lifestyle. Social pressure is a powerful force. People often buy things not because they need them, but because everyone around them has them. We see this in trends, luxury purchases, and career choices influenced by community expectations. Even when people know what's good for them financially, they may still follow the crowd. Spending behavior often reflects emotion more than logic. Impulse purchases happen because something feels good in the moment. Lifestyle inflation creeps in when income increases. People upgrade everything without realizing their habits are growing faster than their wealth. Retail therapy gives temporary comfort, but adds long-term stress. Status spending convinces us that looking successful is more important than being secure. Noticing these patterns is the first step to taking control. Saving and investing require patience, consistency, and long-term thinking, qualities the human mind doesn't naturally prefer. Most people want immediate rewards. That's why it's hard to save regularly or stay calm during market ups and downs. Many avoid investing because they fear losing money, while others jump in and out of markets based on emotion. Behavioral finance teaches us that the problem isn't lack of knowledge. It's the emotional discomfort that comes with long-term discipline. You'll often see that people understand what they should do with money, but still don't do it. That's because habits matter more than information. Real change happens when you recognize your emotional triggers, automate good habits, and build a system that works even on days when motivation is low. Automatic savings, clear goals, simple spending rules, and regular tracking help reduce emotional decision-making. Small, consistent habits do far more than trying to rely on willpower alone. Friend, when you look closely at the relationship between money and human behavior, you start to see that financial success is less about earning more and more about understanding yourself. Managing your behavior is the real path to building a healthier, calmer, and more confident financial life. Wealth creation and compounding. Friend, wealth isn't something that arrives suddenly or magically. It grows quietly, step by step, through habits you repeat over months and years. When you look at anyone who has built real financial stability, you'll see the same pattern. They saved steadily, invested consistently, and gave their money enough time to grow. Wealth creation is really a slow, patient journey, not a quick sprint. It begins with understanding that money becomes powerful only when you allow it to work for you, instead of spending every rupee the moment it comes in. Wealth isn't just about having a high income. It comes from assets that grow in value or generate income. It can come from your savings, your investments, a piece of land, a business, or even something you created that earns money over time. When you put money aside instead of spending it, you're giving it a chance to multiply. That's the beginning of wealth creation. Saving may feel simple, but it's the foundation of everything. Without savings, you have nothing to invest, nothing to fall back on, and nothing to grow. Saving builds security. It creates a cushion for emergencies and gives you the capital you need to start investing. Even a small amount saved regularly becomes meaningful when you stay consistent. Think of saving as planting seeds. They may look small at first, but over time they become something strong and valuable. Once you begin saving, the real magic happens when you invest, and that's where compounding steps in. Compounding is one of the most powerful forces in wealth building. It's the idea that your earnings start earning on their own. It's interest building on interest, growth building on growth. At first, the progress is slow, almost invisible. But as the years pass, compounding speeds up, and suddenly the growth becomes much faster than you expect. The key ingredient in compounding is time. The longer your money stays invested, the stronger compounding becomes. That's why starting early is so important. Even if you start with a small amount, time multiplies it. Staying invested matters just as much as starting. When you avoid unnecessary withdrawals and let your returns reinvest, you allow your money to grow without interruption. And that uninterrupted growth is what creates real wealth. Compounding shows up in many areas of financial life. The interest from your savings account compounds. The returns from mutual funds or stocks compound. Rental income reinvested in more property compounds. Even profits from a business, when reinvested, create compounding growth. The more you allow your earnings to stay in motion, the more they work for you. Investing is essential because it helps your money grow faster than inflation. Inflation eats away at purchasing power, and if your money just sits idle, it loses value over time. Investments like stocks, mutual funds, bonds, and real estate help your money stay ahead. Each option carries different risks, but all give your money a chance to grow. When you understand risk and choose wisely, investing becomes your strongest tool for long-term wealth. But discipline is what ties everything together. Wealth creation is emotional. It's easy to get discouraged when progress feels slow, easy to panic when markets drop, and easy to overspend when you earn more. Long-term thinking helps you stay grounded. When you invest regularly, diversify your choices, and avoid reacting to short-term noise, your wealth can grow steadily. Reinvesting your returns and tracking your progress also keep you on the right path. Many people delay investing or try to time the market. Others withdraw too early or chase high-risk shortcuts hoping to get rich fast. Some ignore fees or interest costs that quietly drain their money. And for many, expenses rise as income rises, leaving nothing to grow. These behaviors slow or even reverse wealth creation. Avoiding them saves you years of financial stress. Friend, wealth creation isn't just for people with high incomes. Anyone can build wealth by saving consistently, investing wisely, and letting compounding do its work. Even small contributions grow over time when they're given enough years. The earlier you start, the easier the journey becomes. The discipline you build today becomes the financial freedom you enjoy tomorrow. Money management for modern life. Friend, managing money in today's world feels different from how it used to be. Everything is faster, more digital, more convenient, and at the same time, more tempting and more expensive. We're surrounded by online shopping, subscriptions, instant payments, easy loans, and financial products everywhere we look. All of this makes life comfortable, but it also creates pressure. Money management, especially now, is about staying in control so your money supports your life instead of silently draining your peace. Money management matters because the financial world has changed. We're dealing with rising expenses, constant advertisements, digital traps, and the pressure to keep up with modern lifestyles. But at the same time, we have powerful tools, apps that help us track spending, online banking for convenience, investment platforms that were once available only to experts. When you learn to manage money well in this environment, you reduce stress, avoid unnecessary debt, build savings, and move steadily toward your goals. It's really about making your financial life calmer and more predictable. The very first step is knowing where your money goes. Most people are surprised when they track their spending honestly. Small daily purchases add up quickly. Coffee, snacks, online orders, monthly subscriptions you forgot about. When you track your income and expenses clearly, patterns start to appear. You notice what's essential and what's not. You see where money leaks silently and how much space you have to save or invest. Tracking is simply awareness, and awareness is power. Once you know where your money is going, you can create a practical budget. A budget isn't a punishment. It's a guide. It helps you tell your money where to go instead of wondering where it disappeared. A good budget includes your income, essential costs like food and rent, your savings goals, your debt payments, and the extra spending that makes life enjoyable. Many people use the 50/30/20ths approach, dividing income between needs, wants, and financial goals. You can adjust it to your own life. The point is to stay organized and intentional. One of the strongest pillars of money management is the emergency fund. Life is unpredictable. A medical bill, a job loss, a sudden repair. These things happen without warning. An emergency fund of 3 to 6 months of essential expenses gives you stability. It protects you from falling into high-interest debt and gives you emotional confidence. When you know you have a safety net, you handle life with far less fear. Managing debt wisely is another key part of financial health. Debt itself isn't the enemy, it depends on how it's used. Good debt helps you build long-term assets, like a home or an education. Bad debt drains your future, especially when the interest rates are high. Paying credit cards in full, avoiding unnecessary borrowing, and focusing on clearing the highest interest debts first keeps your finances strong. Before taking any loan, understanding the terms clearly always helps you make smarter decisions. Saving and investing are essential, both for short-term safety and long-term growth. You save for emergencies, expected expenses, and short-term needs. But you invest for the future, for retirement, for wealth building, for the freedom you want years from now. Investments like mutual funds, index funds, and bonds grow your money in a way that simple savings cannot. When you invest early, consistently, and patiently, compounding works in your favor. One challenge almost everyone faces today is lifestyle inflation. As income increases, spending often increases automatically. A better salary can lead to better gadgets, better vacations, better everything. And suddenly, even extra income starts feeling like not enough. Controlling lifestyle inflation means keeping your expenses reasonable even when you earn more, and directing the extra income towards savings or investments. This one habit can speed up wealth creation more than almost anything else. Technology can be a great ally in managing money. Budgeting apps help track spending. Automation helps save without thinking. Online banking gives easy access to accounts. Investment platforms allow regular, simple investing. Alerts and reminders keep you disciplined. Technology removes effort and replaces it with consistency, a huge advantage in money management. Setting clear financial goals helps you move in the right direction. Whether you want to buy a home, save for retirement, fund education, start a business, or achieve financial independence, having specific goals gives your money a purpose. Reviewing your progress regularly helps you stay on track and make adjustments when needed. Of course, modern life brings common financial mistakes. Overspending on digital platforms, taking on too many subscriptions, ignoring retirement planning, relying on credit cards for daily expenses, or keeping all money in savings instead of investing for growth. When you're aware of these traps, you can avoid them with confidence and clarity. Friend, money management today isn't about strict rules. It's about awareness, balance, and calm decision-making. When you track your expenses, budget wisely, build an emergency fund, manage debt carefully, save consistently, invest early, and avoid unnecessary lifestyle upgrades, your financial life becomes stable. Friends, so many people struggle with money not because they don't earn enough, but because they carry beliefs that quietly guide their decisions. These beliefs come from childhood, culture, habits, or things we've heard over the years. And when these myths remain unchallenged, they limit progress and create unnecessary stress. Understanding these myths and letting them go is one of the most powerful steps you can take toward a healthier financial future. One of the most common myths is the idea that earning more money will automatically solve everything. It sounds logical, but real life shows a different story. Many people with high incomes still live paycheck to paycheck because their spending habits grow just as their income grows. Money doesn't fix money problems. Behavior does. Without discipline, planning, and awareness, even a high salary can feel like it's never enough. Another myth is believing that saving alone is enough, and investing is too risky. Saving gives you safety, but it cannot grow your wealth on its own. Inflation slowly reduces the value of idle money, and without growth, savings lose purchasing power. Investing helps your money grow faster than inflation. And yes, investing carries risk, but with long-term thinking, good diversification, and smart choices, That risk becomes manageable and worthwhile. So many people also believe that debt is always bad, but debt is just a tool. Productive debt, like loans for education, business, or property, can improve your life and build long-term value. The real problem is high-interest debt taken for short-term wants. Instead of avoiding all debt, the better approach is to understand the purpose and cost behind every borrowing decision. There's also the belief that investing is only for rich people. That was true long ago, but not today. Anyone can begin investing with very small amounts thanks to digital platforms and low-cost investment options. The secret isn't how much you start with, it's how consistently you contribute and how long you let compounding work. Another myth that holds people back is thinking they need perfect knowledge to start investing. The truth is, no one ever knows everything. If you wait for perfect understanding, you may never begin. Starting small, learning step by step, and staying diversified helps you grow safely without needing expert-level knowledge on day one. Many people also believe renting is always worse than buying, but that's not universally true. Renting gives flexibility and lower upfront costs. Buying makes sense when you're financially stable, the location is right, and your long-term plan supports ownership. Both choices have benefits depending on your life and goals. Some think budgeting is a harsh restriction, something that takes away enjoyment. But budgeting isn't about saying no. It's about saying yes to what actually matters. A clear budget gives you control, reduces stress, and helps you spend in ways that align with your values. It creates freedom, not limitation. There's also the idea that emergency funds are only for people with unstable jobs. But emergencies don't check your employment status before showing up. Health issues, car repairs, sudden bills. These things can happen to anyone. An emergency fund protects you from falling into debt when life surprises you. Another myth is believing that keeping all your money in the bank is safest. Banks are safe for storing money, but low-interest accounts can't beat inflation. Over time, your money loses value if it never grows. A balanced approach, some in savings, some invested for the future, is far healthier. Many people feel like finance is too complicated for them, but most of the important principles, saving consistently, spending mindfully, avoiding high-interest debt, investing patiently, are simple. Anyone can learn these basics. Tools, apps, and online resources have made financial education more accessible than ever. There's also the belief that money is the root of all problems. But money is neutral. It simply reflects the choices we make. With clarity, planning, and healthy habits, money becomes a tool for stability, comfort, and opportunities rather than stress or conflict. Friend, after walking through this entire journey together, it's clear that the story of money is really the story of us. How we grew as societies, how we solved problems, and how we learned to trust new systems over time. When you step back and look at everything we've covered, you can see how each stage naturally led to the next. Barter pushed people toward commodities. Commodities pushed us toward coins. Coins pushed us toward paper. Paper evolved into fiat currency. And today, our world runs on digital networks, global systems, and new forms of programmable money. But through all this evolution, the human element never disappeared. Money isn't just economics. It's also emotion. Our fears, habits, beliefs, and early experiences shape how we earn, save, spend, and invest. We explored how behavior often matters more than pure financial knowledge, and how myths and misconceptions can quietly hold people back. By understanding these forces, we learn to make decisions that support our goals rather than limit them. I hope these lessons helped you see money with clearer eyes and a calmer mind, helped you understand where it came from, how it works today, and how you can use it wisely in your own life. Remember, the more clarity you have, the more control you gain over your future. If you found value in this audiobook, if it opened your perspective or taught you something meaningful, then stay connected with me. Make sure you like this video, share it with someone who needs it, and subscribe for more content just like this. Thank you for listening, thank you for your time, and I'll meet you again in the next video.